You are watching this market in real time, and what we are witnessing right now feels less like a normal correction and more like a shockwave moving through the financial system. Bitcoin, an asset that only months ago was being discussed in terms of new all-time highs and six-figure projections, suddenly began sliding, dragging altcoins with it, and leaving investors asking the same urgent question: what actually changed? Because if you are standing here with me looking at the screens, you can feel it. This is not panic in the traditional sense. This is something colder, more structural, and far more important to understand. At first, the signals were subtle. Yields on government bonds were not collapsing, but they were not falling fast enough to support aggressive risk-taking either. The US dollar showed periods of unexpected strength. Liquidity indicators, the kind most people never look at, began flattening rather than expanding. These were not dramatic headlines, but they were cracks in the foundation. Markets rarely break without warning. They whisper before they scream. And what we began hearing in late 2025 and early 2026 were those whispers: funding conditions tightening, capital rotating, and large portfolios quietly rebalancing. You have to understand something important here. Bitcoin is no longer a fringe asset, traded only by retail investors and small speculative funds. The scale of capital involved today means that macro forces, interest rates, real yields, currency flows, have a much stronger influence than many people realize. When global liquidity expands, risk assets thrive. We saw this in the years following the 2020 pandemic response, when central banks injected unprecedented liquidity into the system. Technology stocks surged, commodities rallied, and Bitcoin entered one of its most powerful bull phases in history. That environment conditioned investors to expect that trend to continue indefinitely. But liquidity cycles do not move in straight lines. They move in waves. And what we are seeing now is the crest of one of those waves beginning to roll over. Even without dramatic rate hikes, financial conditions can tighten simply because expectations change. When investors begin to believe that borrowing costs will remain higher for longer, or that central banks will not be as accommodative as before, capital becomes more cautious. Risk appetite contracts, not overnight, not in panic, but steadily, almost invisibly at first. Look back at history for a moment. In 2018, global markets experienced a similar adjustment when the Federal Reserve was shrinking its balance sheet and real yields were rising. Equities struggled, emerging markets weakened, and Bitcoin entered a prolonged decline. The mechanism was the same. Liquidity was no longer expanding at the pace markets had become accustomed to. And when liquidity slows, the marginal buyer, the next person willing to pay a higher price, becomes harder to find. Now, as you watch the current cycle unfold, you can see echoes of that pattern. Bitcoin's market capitalization has grown so large that sustaining rapid price increases requires massive inflows of capital. This is no longer a small market that can double on a wave of retail enthusiasm alone. It is an asset class integrated into the broader financial system, and that integration brings both stability and vulnerability. Stability, because institutional investors tend to avoid panic. Vulnerability, because institutional investors also rebalance portfolios systematically, reducing exposure after strong rallies or when volatility rises. What confirms this interpretation is the nature of the sell-off itself. If this were a true panic, you would see cascading liquidations, exchange outages, and disorderly price action across all timeframes. Instead, what we have seen is something more controlled, more measured. A steady reduction in leverage, a gradual decline toward long-term technical levels, and periods of stabilization, even amid negative headlines. That tells you something critical. The market is adjusting, not collapsing. And yet there is a contradiction here that many people struggle to reconcile. On one hand, long-term fundamentals remain intact. Supply continues to tighten over time. Institutional adoption has not reversed. And the infrastructure supporting the market is stronger than it was in previous cycles. On the other hand, prices are falling, sentiment is weakening, and the narrative has shifted from optimism to uncertainty. How can both of these realities exist at the same time? The answer lies in time horizons. Markets do not move in straight lines toward their long-term potential. They move in cycles, and those cycles are driven as much by liquidity and psychology as by fundamentals. A tightening in global financial conditions can create months of downward pressure even while structural drivers remain positive. This is not a contradiction. It is the nature of financial markets themselves. If you step back and look at the bigger picture, what we are witnessing is not the failure of Bitcoin or the end of the crypto cycle. What we are witnessing is the first major reason behind this decline, a shift in the macro liquidity environment. Capital is becoming more selective, risk tolerance is adjusting, and the enormous flows that once pushed prices upward with relentless momentum are no longer moving at the same speed. And that brings us to the point you need to remember as you watch these markets in the days ahead. Corrections driven by macro conditions tend to unfold gradually, and they tend to end not with a dramatic reversal, but with a slow stabilization as liquidity conditions find a new equilibrium. The screens in front of us may still be flashing red. Headlines may still sound alarming, but beneath the noise, the deeper forces at work are not chaotic. They are structural, cyclical, and above all, understandable once you know where to look. If you are watching the screens right now, you can feel that the movement we are witnessing is not random. Prices do not fall this way by accident. They fall in layers, in waves, in a pattern that reveals the machinery underneath the market. And what you are seeing at this moment is the second force behind this decline, the unwinding of leverage and the hidden structure of the crypto market revealing itself in real time. Let me explain something to you clearly, because this is where many people misunderstand what is happening. Markets today are not driven only by buyers and sellers exchanging assets in the traditional sense. A huge portion of activity comes from derivatives, futures, perpetual contracts, structured products, positions built on borrowed capital. When prices rise for months, confidence grows. Traders increase exposure, funds amplify positions, leverage builds quietly, almost invisibly, like pressure building inside a sealed chamber. You do not notice the pressure while prices are rising, but the moment prices hesitate, the entire system begins to adjust. Look at historical parallels for a moment. In 2008, the collapse of leveraged mortgage structures did not begin with panic. It began with small cracks, rising defaults, declining collateral values, tightening credit. In 2018, volatility returned to equity markets after years of calm, and leveraged exchange-traded products collapsed within days, not because investors suddenly changed their beliefs, but because the structure of the market forced selling. Leverage does not forgive hesitation, it reacts mechanically, and that is exactly what we are seeing here. As Bitcoin began to pull back from its highs, leveraged positions that had been built during the rally began to shrink, not in chaos, not in a stampede, but systematically. Positions were reduced, margins were adjusted, risk desks made decisions. This is what orderly deleveraging looks like, and it is very different from panic selling. The difference is important because panic destroys markets, while deleveraging reshapes them. You might be wondering why prices can fall so sharply, even when the long-term story has not changed. The answer is simple, but uncomfortable. Short-term prices are often driven more by positioning than by fundamentals. When too many participants are leaning in the same direction, the market becomes fragile. It does not take bad news to trigger a move. It only takes a shift in momentum. Another factor you must understand is liquidity concentration. Unlike traditional financial markets with deep, distributed liquidity, large portions of crypto trading are concentrated in a limited number of venues and desks. When a major lender pauses withdrawals, or when a large trading entity reduces exposure, the effect spreads quickly. Confidence moves faster than capital, and when confidence hesitates, even briefly, prices respond immediately. You have seen this pattern before, even if you did not recognize it at the time. In 2022, when several large crypto institutions collapsed, liquidity vanished almost overnight. What we are seeing now is not that extreme, but the memory of those events still shapes behavior. Participants move faster, reduce risk earlier, and react more cautiously than they once did. That alone can accelerate a decline. Now look at altcoins, and you will see an even clearer picture of this mechanism. Altcoins are not just smaller versions of Bitcoin, they are structurally more sensitive to liquidity conditions. Their order books are thinner, their investor base is more speculative. When leverage unwinds, capital exits these markets first, amplifying declines and creating the impression of a broader collapse. In reality, what you are seeing is a hierarchy of risk being unwound step by step. But here is where the situation becomes more complex, and I want you to pay attention to this contradiction. Despite the declines, volatility remains lower than during previous bear markets. The system is under pressure, but it is not breaking. That tells you something critical about how the market has evolved. Infrastructure is stronger. Risk management is more disciplined. Large players are acting methodically rather than emotionally. And yet, the effect on price is still dramatic enough to shock observers who are not watching the internal mechanics. That is the nature of leverage. It magnifies movements even when the underlying forces are controlled. There is another historical parallel that helps explain this moment. In the early 2000s, after the dot-com bubble peaked, many technology stocks fell not only because their fundamentals were questioned, but because margin debt and speculative positions had to be unwound. The selling did not happen in one catastrophic collapse. It happened in waves, each wave triggered by the need to reduce exposure. The process took time, and during that time, narratives shifted, confidence weakened, and markets searched for a new equilibrium. That is the stage we are entering now. What you are witnessing is not merely a drop in price. It is the visible surface of a deeper process, the resetting of leverage, the recalibration of risk, and the restructuring of positions built during one of the most powerful rallies in crypto history. These processes are not emotional, they are mechanical. They operate regardless of headlines, regardless of opinions, regardless of what anyone hopes the market will do. And that is why the movements feel so relentless at times, because once deleveraging begins, it tends to continue until the system reaches a point where leverage is no longer excessive and positions are balanced again. So as you stand here watching this unfold, remember what is truly happening beneath the surface. This is not chaos. This is not the sudden disappearance of value. This is the second major force behind the decline, the unwinding of leverage and the internal mechanics of a market that has grown larger, more complex, and more interconnected than ever before. And the most important thing to understand is this: processes like this do not end in a single dramatic moment. They end quietly, almost invisibly, when the pressure that built up over months has finally been released, and only then does the market begin to breathe again. If you are looking at the market right now and asking yourself why selling continues even after leverage has been reduced and macro conditions are already widely discussed, then you are beginning to see the third force at work. And I want you to pay close attention to this, because this force is quieter than liquidity, less visible than leverage, but often more powerful than both. What you are witnessing now is psychology, investor behavior, expectation cycles, and the slow shift in narrative that changes markets long before fundamentals change. You can feel it in the tone of conversations, in the way headlines are written, in the hesitation that creeps into decisions. Only months ago, the dominant narrative was certainty. People spoke about price targets as if they were inevitable. Every pullback was described as a buying opportunity, every rally as confirmation of a new era. But narratives in financial markets are fragile. They depend on momentum, and when momentum weakens, confidence does not collapse instantly. It erodes. This erosion is happening right in front of you. Let me explain how this process unfolds, because it follows a pattern that has repeated throughout financial history. After a prolonged rally, long-term holders begin to take profits, not out of fear, but out of discipline. Portfolio managers rebalance. Early investors secure gains. Funds that rode the trend begin to reduce exposure to lock in performance for the year. None of this appears dramatic on the surface, but together, these actions create a persistent current of selling that weighs on prices day after day. You have seen this before, even if you did not recognize it at the time. After the gold rally in 2011, the price did not collapse overnight. It drifted lower for months as large investors gradually exited positions. The same happened in technology stocks after 2021, when valuations began to compress, not because companies disappeared, but because expectations had simply run too far ahead of reality. Markets do not always crash. Sometimes they deflate. And that is what psychology looks like in action. Another element you need to understand is the phenomenon often described as priced in. When a major event approaches, whether it is a halving, an ETF approval, or a widely anticipated policy shift, markets tend to move in advance. Investors position themselves early, pushing prices higher in anticipation of future demand. But once the event arrives, or once optimism reaches a peak, there are fewer new buyers left to sustain the rally. Prices begin to stall. And when they stall, sentiment begins to change. You can see that transition happening now. Expectations were enormous. Forecasts became more ambitious with each passing month. And when reality fails to match the most extreme expectations, disappointment becomes a powerful force, even when the underlying situation remains strong. There is also something else happening beneath the surface that many people underestimate: the role of media amplification and social sentiment. Information moves instantly now. A negative headline spreads across the world in minutes. Fear travels faster than analysis. Retail investors, who often enter markets during the most optimistic phases, react quickly to sharp moves. Selling accelerates, not because fundamentals have changed overnight, but because perception has shifted. And perception in financial markets can become reality, at least in the short term. But here is the contradiction that defines this stage of the cycle, and I want you to think about this carefully. At the same time that some investors are selling in disappointment or fear, others are observing the same market with calm, even patience. Long-term participants understand that volatility is not an anomaly, it is a feature. They have seen cycles before. They recognize the emotional rhythm of markets, the optimism, the euphoria, the doubt, the fatigue. Right now, the market is moving through that phase of doubt. Think back to 2017 and 2018. Bitcoin rose with extraordinary speed, driven by enthusiasm and expanding participation. But when the decline began, the most powerful force was not leverage or macro conditions alone. It was the collapse of belief in the inevitability of endless growth. The same psychological shift occurred in equity markets after the dot-com bubble. Investors did not suddenly lose the internet. They lost the conviction that every company would dominate the future. That loss of conviction is subtle, but it changes everything. And yet, here is the part that most observers miss. Psychology does not move in only one direction. Just as optimism can become excessive, pessimism can also overshoot reality. Markets often reach points where fear becomes exaggerated, where narratives become darker than the underlying data justifies. Those moments are rarely recognized in real time because emotion clouds judgment. So, as you stand here watching these movements, you are not just observing price action. You are witnessing the emotional cycle of a market in transition. Profit-taking, shifting expectations, and the gradual rewriting of narratives. These are the forces shaping the third reason behind the decline. And if you listen carefully, you can almost hear the change in tone across the entire ecosystem. The conversations are quieter. The certainty is gone. Questions have replaced predictions. That is what a psychological reset looks like. But remember this, because it is critical, markets do not move only on data, and they do not recover only on data either. They move when belief changes. They turn when perception shifts. And those shifts rarely announce themselves in advance. They emerge slowly, almost invisibly, until one day you realize that sentiment has already turned and the cycle has begun again. If you are still here with me, watching this unfold in real time, then you already understand something that many people outside the market do not. A decline like this is never just about the fall itself. It is about what survives the fall. And right now, as prices fluctuate and headlines compete for attention, there is a deeper question forming beneath the noise. What remains unchanged beneath all this volatility? Because when you strip away the emotion, the leverage, the narratives and the daily price movements, you are left with structure. And structure is what determines the long-term direction of any market. Look at Bitcoin's design for a moment. Unlike traditional currencies, its supply is fixed. This is not a slogan or a marketing phrase. It is a mathematical constraint embedded into the system itself. Approximately every 4 years, the rate of new supply entering the market is cut in half. This mechanism does not respond to politics, does not react to economic cycles, and does not change because sentiment shifts. It continues, block by block, regardless of what the price does. History gives us a powerful parallel here. Think about gold in the 1970s, when inflation accelerated and monetary systems began to shift after the collapse of Bretton Woods. Gold did not rise in a straight line. It experienced sharp corrections, periods of doubt, and moments when analysts declared the rally finished. Yet the structural drivers, scarcity, monetary uncertainty, and demand for a store of value, continued to operate beneath the surface. Over time, those forces reasserted themselves. You are witnessing a similar dynamic now, though in a different technological era. The structural forces behind Bitcoin are not daily headlines or speculative enthusiasm. They are the mechanics of supply, the gradual integration into financial infrastructure, and the slow but persistent expansion of institutional participation. And I want you to notice something that is happening quietly, almost invisibly, while attention is focused on price declines. Large capital does not move quickly. Pension funds, asset managers, and institutional desks operate on timelines measured in quarters and years, not days. Their activity rarely creates dramatic headlines, but it shapes the underlying demand in ways that only become visible over long periods. This is why corrections in mature markets often look different from collapses in immature ones. In earlier cycles, infrastructure failures, exchange collapses, and systemic breakdowns amplified every decline. Today, despite volatility, the system continues to function. Trading continues. Settlement continues. Capital flows continue. The market bends, but it does not break. And yet, here again, we face a contradiction. If the long-term structure remains intact, why do these declines feel so intense, so unsettling, so dramatic? The answer lies in the nature of financial markets themselves. Markets move at the speed of information and emotion, but fundamentals move at the speed of time. The gap between those two speeds is where volatility lives. Think back to the early days of the internet economy. There were moments when technology stocks fell sharply, when analysts questioned valuations, when investors lost confidence. But the underlying transformation of the global economy did not stop. Infrastructure kept expanding. Adoption kept growing. Years later, it became clear that the corrections were part of a larger process, not the end of the story. What you are seeing now carries echoes of that pattern. The crypto market is no longer a small, experimental corner of finance. It is a developing asset class interacting with global capital, macroeconomic cycles, and institutional frameworks. That interaction creates volatility, but it also creates resilience. And here's something I want you to hold in your mind as you watch the screens in the days and weeks ahead. Every major asset that has risen to global prominence has passed through phases like this, periods of expansion, consolidation, doubt, and renewal. Oil markets, equity markets, precious metals, emerging market currencies. They have all moved through cycles that felt uncertain in real time but appear inevitable in hindsight. Right now, you are standing inside one of those cycles. The final reason behind this decline is not a single event or a single piece of news. It is the natural process of a market maturing, absorbing shocks, recalibrating expectations, and finding equilibrium before the next phase begins. Supply dynamics, institutional integration, and structural growth continue beneath the surface, even as prices fluctuate above it. So, as you watch this moment unfold, remember what is truly happening. You are not just witnessing a downturn. You are witnessing a system adjusting to its own scale, a market learning to breathe at a different rhythm, a financial phenomenon transitioning from its early, explosive phase into something more complex, more interconnected, and ultimately more durable. And the most important thing to understand is this: cycles do not end when fear is loudest. They end quietly, when the noise fades, when volatility subsides, and when the forces that were always there beneath the surface begin once again to move the market forward in ways that only become obvious after the fact.